What we're going to do now is to look at another example of regression analysis in practice. And this example is on the determinants and impacts of sovereign credit ratings. This paper was written by Kantor and Packer, and it was published in 1996 as a Federal Reserve Bank of New York discussion paper and in the Journal of Fixed Income. So first of all, a little bit of background. What are sovereign credit ratings and why are we interested in them? Well, you might already be aware of the answers to these questions from other components of the MSc course that you've done. But essentially, credit ratings are issued by many different credit ratings agencies, but there are two very important ones, known as Moody's and Standard & Poor's. And Moody's and Standard & Poor's offer credit ratings which are measures of credit worthiness or measures of the ability of firms and governments to meet their obligations to pay debt interest and to repay principal at the maturity date for the bond. So credit ratings are issued for every firm or government that wants to issue funds on the international debt markets. And sovereign credit ratings refer to the credit ratings that are given to whole governments or whole countries. Why are we interested in these things? Well, obviously, as academics, we're interested in explaining anything that's going on in the financial markets. But in particular, there are a number of uses which we could put the models which are developed here to. For example, one of the things that we're going to do is to try and examine how the credit ratings agencies arrived at their ratings. Now, this is very useful to us because it turns out that the credit ratings agencies shroud the factors that they use in their judgments in great secrecy. So we cannot ask Standard & Poor's, for example, how do you arrive at your credit ratings rating for each country or for each bond? They simply wouldn't tell us the answer to that question. So what we can do instead is to say, well, given the ratings that are assigned and given a set of factors that we think probably affected those ratings, can we decide which of those factors were in fact important and what the relative weighting given to each of those factors in reaching the credit assignment decision was? And the answer to that question is yes, we can get a good idea of roughly what the weights that were used were. Once we've got a model which helps us to determine how the credit ratings agencies arrived at their ratings, then we can use such models in order to be able to forecast or predict what the likely ratings will be for governments or countries which had not previously issued debt. So, for example, suppose a new East European country, which is a former USSR state, decides that it wants to issue debt for the first time. We can decide, using the model that's developed, what is likely to be the credit rating that they would be assigned. Also, in credit markets, it's in fact the case that credit ratings don't stay the same for all countries through time, but rather there's a dynamic process of adjustment where credit ratings that are assigned to governments or to particular bonds may rise or fall. We can therefore perform a kind of counterfactual analysis and say, well, what happens if one of the variables that we think affects credit ratings changes by a particular amount? What is likely to be the impact on the credit rating? So these are all useful decisions which we can make using the models that are developed here. Now, the first thing that we have to do is to examine the credit ratings. Now, the credit ratings that are given to governments vary from AAA, which is the highest possible credit quality for an issuer and implies the highest probability that that government will be able to meet its obligations to pay debt interest and to repay the principal, down to B3 under the Moody's terminology and B- under the Standard & Poor's terminology, which is the lowest credit quality that was assigned to any government in the Kantor and Packer sample. Now, the first thing we have to think about is that, in fact, these credit ratings or credit qualities are what we might call qualitative variables. That each of these ratings is represented by a letter or set of letters rather than a number. And the first thing that we'll need to do is to quantify these so that we can actually use them into a model. Now, we'll come on to the model in a few moments, but first of all, let us examine what the purposes of the study were. The first and most important purpose is to attempt to explain and model how the ratings agencies arrived at their ratings. So, given that we know what the ratings are, can we decide an appropriate set of factors and weightings that were assigned to each of those factors which determined why given countries or given governments received given ratings? Secondly, once we've got a model that explains how the ratings agencies arrived at their ratings, can we use that same model and those factors to determine what the spread of the yields on these sovereign or government bonds were above a risk-free rate of interest proxy? And the risk-free rate of interest proxy that's used in this paper is the US Treasury bond yield. And it turns out that no government had a yield on their bonds which was lower than the US Treasury yield. Finally, once we've done that, as I said already, it's likely to be the case over time that credit ratings assigned to each government or to each bond change. So can we examine what factors determine how sovereign yields will react to ratings announcements? So when there's announcements in the market that the credit rating assigned to a particular government or a particular bond is changed, what factors determine to what extent the yield spread will rise or fall? So these are the three important questions that are asked by the authors. So first of all, coming back to the question of the ratings, as I said, these are what we call qualitative variables. That is, they're variables which are denoted by letters rather than by numbers. So what we do is to assign each of these qualitative variables an ordinal number. So we give the highest credit rating, a AAA rating, a score, if you like, of 16 points. And as I said, the lowest credit rating that was offered to any government in the Kantor and Packer sample is B3 or B-, and we assign that a score of 1. So this credit score for each country then becomes the dependent variable that we use in the first set of regressions. So we're actually doing a cross-sectional regression where we try to explain the cross-sectional variation in the credit ratings that are assigned to each of these governments. Now, what are the explanatory variables? Well, in the context of determining the credit ratings for actual firms, then the explanatory variables in such a regression would be variables that measured the creditworthiness of firms. And those would be things like financial ratios that measured the financial health or financial stability of the firm. For example, liquidity ratios, debt to equity ratios, its profitability, its return on equity, its cash reserves, and so on and so on. And we'd also have more kind of qualitative or judgmental variables that would measure how good we thought the firm's management were, how stable we thought the demand for its product was. You know, is the demand for its product rising or falling over time, for example? How strong is its competition, and so on. Well, we use similar kinds of variables in the context of sovereign credit ratings. And the variables that are used in the context of sovereign credit ratings are variables that embody or measure the creditworthiness of governments. And obviously governments raise money through taxing the citizens of that country. So these measures are also measures of the creditworthiness of the country as a whole. So these are mainly kind of macroeconomic variables that measure how stable and how safe is the economy in that country. How likely is it that the government is going to be able to meet its debt payment obligations? Now, we need to also be aware of the units of measurement of each of these variables so that we can sensibly interpret the sizes of the coefficient estimates that we obtain from the regression equations. And we do that by relating the units of measurement of the independent variables to the units of measurement of the dependent variable. I'll come on to that point a bit later again when we come to actually look at the results. So on the slide, the units of measurement of each of the variables are given in parentheses after the names of the explanatory variables. Now, as I said, we're doing a cross-sectional regression here, so we take a kind of snapshot at one particular point in time. So unless otherwise stated, all of the variables are measured in 1994. So the first variable is per capita income in 1994, measured for all countries in terms of thousands of US dollars. As well as the kind of quantity or value of per capita income, we also use as a variable in the regression model the rate of change in that income measured by GDP growth over the previous 3 years. So why is income and income growth an important determinant of credit quality or credit worthiness? Well, the authors suggest several reasons why these factors are important. The first one is that obviously governments who borrow money raise the money that they need to be able to repay that debt and to meet the interest payments through taxing the citizens of that country. And obviously, if per capita incomes are high and rising, that means that the tax base in the country is high and rising. So that means that, if need be, the government can raise the revenue necessary to be able to meet its debt obligation payments by increasing taxes in the country. The authors also suggest that there's a high degree of correlation between per capita income and political and economic stability in the country. So it's usually the case that countries with high per capita incomes also are very politically and economically stable countries. And obviously political and economic stability are also going to be important impacts on credit worthiness. The next explanatory variable that's used in the regression is average annual inflation over the 1992 to 1994 period. Why is inflation important? Well, again, the authors suggest a number of reasons. First, and probably most importantly, inflation is a measure of the extent to which the purchasing power of debt holders' investments is being eroded through time. So if a particular government is in a country with a high inflation rate, that means that the bondholders of that sovereign debt have an investment which is gradually being eroded in terms of its purchasing power. So we would expect countries with high inflation rates to have low credit worthiness, simply because the value of the bonds in terms of what we can actually buy with the money that those bonds are worth is gradually being eroded through time. Secondly, they argue that implicitly inflation is a measure of how good a control a government has got of its economy and of its money supply in particular. So if inflation is rife in a particular economy, that means that the government may well have lost control of the money supply, and again, that's indicative of economic and perhaps even political instability in a country. Once again, countries that are politically and economically stable tend often to have relatively low rates of inflation. The next factor that's in the model is the fiscal balance of the country. That is the average annual government budget surplus as a proportion of GDP. Obviously, if a government is running a large budget deficit, its ability to meet its debt interest obligations is likely to be reduced compared with a country that has a large budget surplus. So the financial health of the government and how much kind of slack there is in the system, if you like, for the government to be able to meet its interest payments, even if its tax receipts fall or the benefit payments that it has to make rise, is increased if the government has a large budget surplus rather than if the government has a large budget deficit. The next factor, or rather the next two factors, measure how indebted the people in the country as a whole are, incorporating both the private and the public sector. And those two factors are, first of all, what we might call the external balance of the country. In economic terms, we call this the average annual current account surplus as a proportion of GDP. And broadly speaking, for those people who haven't had any training in economics, this is roughly speaking the difference between exports and imports. If imports are larger than exports, that means in a sense that the country is running a trade deficit. And that means potentially that the country is becoming more and more indebted to those abroad than it was previously. As well as measuring the kind of flow of indebtedness of the country as a whole, which we would do using the difference between exports and imports, we also measure the kind of stock of external foreign currency debt as a proportion of exports. Once again, taken together, those two variables explain how indebted the people in the private and public sector are taken together. And we would expect a country with a very high indebtedness overall, or a country which is running a large trade deficit, to have a relatively low creditworthiness compared to a country that's running a trade surplus or that has a very small national debt as a proportion of its exports or as a proportion of its GDP. Finally, the authors use two dummy variables which are 0-1 dummy variables. The first dummy variable is a dummy variable for economic development, and that dummy variable takes the value 0 for developing countries and the value 1 for any developed countries. And the authors argue that the difference between the creditworthiness of developing and developed countries is larger than the differences in the average values of those previous explanatory variables would suggest. So in other words, if we took two identical countries with identical per capita income, inflation, fiscal balance, external debt and so on, then the country which was developing would still have a lower credit rating than an otherwise identical developed country. This might, for example, result from the relative political and economic instability that surrounds many developing countries compared with developed countries, which once again would be expected to lower the creditworthiness of the former. Similarly, the authors argue that if a government has already defaulted on its debt, it's more likely to do so again, and therefore its creditworthiness would be lower relative to a government which has never defaulted. Now, the authors also say that they transform income and inflation to their natural logarithms in order to remove possible problems with heteroskedasticity. Now, you may have thought, well, perhaps what we should do if we're concerned about heteroskedasticity would be to use natural logarithms of all of the variables. But obviously it wouldn't make sense to take natural logarithms of a dummy variable. Equally, it wouldn't make sense to take natural logarithms of any variable which measured the change in something, because it's possible that the change in something could be negative, and obviously we can't take logarithms of negative numbers. So the authors only take the natural logarithms of income and inflation as explanatory variables in the regression model. So if we now come to have a look at the results, we've got four sets of results from estimating the model that I've just described. Now, some of you who've done some econometrics before may have thought that it would be inappropriate to use ordinary least squares in the context of this kind of regression model because the dependent variable can only take on a certain limited range of values. We've implicitly assumed in the past that when we estimate regression models, the dependent variable can take on any value that it chooses to. But obviously, because of the way that we've constructed the problem in this case, the dependent variable can only take on integer values between 1 and 16. Now, it turns out that, strictly speaking, we shouldn't use ordinary least squares in this context. And what we should instead use is a technique known as ordered probit. So we could use an ordered probit type model, and that would be a model which explicitly allows for the fact that the dependent variable is limited. That is, the dependent variable can only take on a limited range of values. Now, the authors argue that they experimented with the ordered probit specification, but it turns out that because the number of categories of dependent variable is large, we've got 16 different categories corresponding to each of the credit ratings, and because their sample size is relatively small, it's approximately 15 observations, they argue that there isn't really any useful gain from using ordered probit. So instead of using ordered probit, the authors revert to using ordinary least squares. So in fact, all of the regression models that are estimated here simply use ordinary least squares rather than ordered probit. Now, as I said, we've got four different sets of results that we can look at. The first thing we could do is say, well, let's use the ratings given by Moody's and try and explain the cross-sectional variation in Moody's ratings. We could then separately try to explain the cross-sectional variation in S&P ratings. And then most of the time, that is for most countries, the Moody's and S&P ratings will be the same. That is, for example, if Moody's assigns a AAA rating, in other words, the country is of the highest possible credit quality, then S&P will also assign a AAA rating and say that that country is also of the highest possible credit rating. But there will be instances, some countries, where credit ratings differ between the two agencies. So, for example, Moody's might say that a country is rated AAA and we will give that a score of 16 points, but S&P give it a rating of one notch less than that, and therefore we would only give it a score of 15 points. What we can then do is try to take the average of each of those two ratings and use the average rating or the average score as another dependent variable which we can explain. Finally, if we've got ratings for Moody's and we've got ratings for S&P, we can try to explain the difference between these two sets of ratings. And we can say, can we explain the cross-sectional variation in the difference between Moody's and S&P ratings? In other words, can we explain which factors S&P and Moody's weight differently when they're coming to their credit quality assignment? So we look at all four of those things. In the second column of the table, I've put what we might call the expected a priori sign of the estimated parameter. So, for example, we would, as I said, expect that if per capita income rises, then we would expect the credit rating to be higher. So we'd expect a positive sign on the parameter associated with per capita income. Now, if we look at the average ratings and the Moody's ratings and the S&P ratings all together, we can see that all of the variables have their anticipated sign. That is, if given what the variable represents, we expected a positive sign, it turns out that the parameter does indeed have a positive sign. If the variable was expected to have a negative sign, the parameter does indeed, when we estimate it, have a negative sign. So that's something that's good about the model. That suggests that the estimated model is a sensible and reliable one. We can also examine the statistical significance of each of the parameter estimates and say which of the variables are most important in explaining the cross-sectional variation in the credit ratings. And whether we use Moody's rating, S&P rating, or the average of the two ratings, we get almost the same picture in each case. So once again, that's something good that we like to see. And in fact, it's per capita income, inflation, external debt, the development dummy, and the default dummy that are the most important explanatory variables. In this table, I've put the estimated T-ratios on the parameter estimates in parentheses, and I've used asterisks to denote statistical significance. So 3 asterisks, i.e. 3 stars, denotes a variable that's significant at 1%. So that's a very important, very significant variable. So there are 6 variables that significantly seem to impact on credit worthiness or credit assignments. The final thing that we can do to interpret the estimated regression model is to say, do the parameter estimates have the sizes that we would have expected them to have? And if we look at these parameter estimates, we can see by and large they seem to do so. So, for example, per capita income was measured in thousands of US dollars. And the way to interpret an estimate on the average rating regression of 1.2 is to say that if we compare 2 countries that are otherwise identical and one has a per capita income that's $1,000 higher than the other one, then the country with the $1,000 higher per capita income will have a credit rating that's on average 1.2 notches or units higher than the otherwise identical country with a $1,000 per capita income lower. Similarly, we could interpret GDP growth and the other variables in the same way. To give you one other illustration, inflation is measured in percentage points, and a value of minus 0.6 says that if a country, if we compare 2 countries, again that are otherwise identical, i.e. we hold the values of all the other factors constant, if one country has an inflation rate that's 1 percentage point higher than the other country, then the country with a 1 percentage point higher inflation rate will have a credit rating that's on average minus 0.6 notches higher. In other words, the country with a 1 percentage point higher inflation rate will have a 0.6 notch lower credit rating on average. If we finally come to examine the parameter estimates on the dummy variables, we need to again think carefully about how we interpret those. The development dummy variable can be interpreted as saying that if we compare between two otherwise identical countries, and obviously in practice there might not be two otherwise identical countries, one of which is developing and one of which is developed, but if we assume that existed, then the developed country would have a credit rating that is on average about 2.8 notches or units higher than the otherwise identical developing country. And a country which has previously already defaulted on its debt would have an average credit rating that is about 2 notches or 2 units lower than would be the case for an otherwise identical country that had never defaulted on its debt. If we now come to examine the last column in this table, that is the difference between the Moody's and the S&P rating. And they seem to be three factors, apart from the intercept, which we're not really interested in interpreting. There seem to be three factors which Moody's and S&P seem to place significantly different weights on. And those are per capita income, external debt, and the default dummy. Now, if we look at the coefficient estimates on the per capita income variable, those are higher for the S&P regression than for the Moody's regression. This suggests that S&P attaches statistically significantly higher weighting on per capita income than Moody's do. And we could apply a similar logic to the inflation variable, to external debt, and to the default dummy. So what we've done on this table is we've tried to explain how the ratings agencies arrive at their rating. And the coefficient estimates that we get in those regressions can be interpreted as the kind of weights or influences that each of those factors have in determining the rating that was assigned by each of those ratings agencies. If we look at the values of the adjusted R-squared coefficient for each of these four regressions, we can see in all cases that the adjusted R-squared is about 0.9. That says that roughly speaking, 90% of the cross-sectional variation in the credit ratings has been explained by the model. Now, usually the R-squared and adjusted R-squared figures for cross-sectional regressions are relatively low. So to see adjusted R-squared figures this high is a very good sign about the model and suggests that the model is a relatively good one. In other words, it seems to be explaining most of what we want to explain. If we now go ahead to think in a kind of statistical perspective about whether the model is a good one or not, as I said, the first thing we can say is that the adjusted R-squareds are high, which is indicative that the model is explaining most of what we want to explain. But there are virtually no diagnostic tests given in the paper. Now, we know the problems that can occur when diagnostic testing is not done by researchers and when violations of the assumptions of the classical linear regression model exist in practice. So the fact that the authors haven't really bothered to do very much in the way of diagnostic testing would lead us to question the reliability or robustness of the results that those authors have reached. Another thing that we can do is to examine the residuals from the model and to see whether the residuals from the estimated model are very large for some countries or not. Obviously, what we want to see is a set of estimated residuals that are relatively small for every country. And indeed, in this case, the authors argue that that's exactly what we find. Now, it turns out that for 70% of the countries in the sample, the difference between the actual and fitted rating is only half a unit or half a notch or less. What does that mean? Well, we know that the actual ratings, because of the way that we've constructed them, only take on integer values. So the actual ratings take on a value of 1 or 2 or 3 and so on, up to 16, varying for each different country. But there's nothing that, in the way that we've set up the model, which would ensure that the fitted ratings from the model take on integer values. So we might have an actual rating of 15, but a fitted rating of 14.7. Now, obviously, if we then round the fitted rating to the nearest integer, we could therefore argue that any residual that's less than 0.5, i.e. where the difference between the actual and fitted ratings is less than 0.5, we could argue that when we round the fitted rating to the nearest integer, we've then got a perfect prediction of the model of the credit quality for that particular government or country. So in 70% of the cases, we've essentially got a perfect fit of the model to the ratings for those particular countries, which is good. And it also turns out that in no cases have we got credit ratings which are more than 3 notches or 3 units away from their estimated values. So for no countries are the residuals bigger than 3 notches or 3 creditworthiness units. And for only 4 countries is the difference between the actual and fitted rating 1 or 2 units. So overall, the model seems to fit the data very well. We've already answered the question, do the coefficients have their expected signs and sizes? By and large, the answer to that question seems to be yes. If we now go on to consider the second question which the authors addressed, that is, do ratings add to publicly available information, then we need to switch the dependent variable. Now previously the dependent variable was the actual credit rating which was given a numerical value from 1 to 16. Now the dependent variable is what we might call the log of the yield spread. That is the log of the difference of the yield on the sovereign bond to the yield on a US Treasury bond. And as I said, no other country had a lower yield on its sovereign bonds than the US, and therefore there's no danger that this yield spread could become negative and so we couldn't take the log. So now this then becomes our new dependent variable in the second sets of regressions. If we look at the results from that second set of regressions, we estimate 3 sets of models. In all 3 cases, the dependent variable is the same, that is the log of the yield spread, and only the explanatory variables are different. So the 3 regression models that we estimate are, first of all, a model which only includes the credit rating for that country. So we're only trying to explain the log of the yield spread across the countries by reference to the variation in the credit ratings across the countries, where the credit ratings are measured as the average ratings averaged over the Moody's and S&P ratings. The second regression excludes the credit ratings but includes that whole list of macroeconomic variables that were used in the last set of regressions. Finally, we estimate a third regression where we include both the average credit rating and all of the macroeconomic variables. If we examine each of these regressions in turn, first of all, looking at the first regression model, we can see that the average rating parameter estimate is very, very statistically significant. It's got a t-ratio of -19, so that suggests that the average rating is a very, very important determinant of the log of the yield spread. If we now look at the second set of regression estimates, that suggests that there are now only 3 factors that significantly explain the log of the yield spread, and those factors are external debt and the 2 dummy variables. If we finally examine the third regression, which we might call a hybrid or a composite or an encompassing regression, it's obviously an encompassing regression because it includes all of the variables from the first 2 regressions. If we look at that regression estimate, we can see that in this model, only the average rating is significant. So what that means is that once we allow for the impact of the average credit rating on the log of the yield spread, then the macroeconomic variables have no further explanatory power for this yield spread. So, in other words, if we know what the average credit rating is assigned to each of these countries, we don't need to worry about gathering data on all of these macroeconomic variables because we can't do any more to explain them than we could by just using the average credit rating. Also, if we look at the final row in the table, which is the adjusted R squared from this regression, we can see that adjusted R squared is highest from the regression which only includes the rating and specifically excludes the macroeconomic variables. So the average rating is doing a good job of explaining the log of the yield spread. Now we can interpret this result in two ways. The first would be to say that the credit ratings agencies are doing a good job of incorporating the correct and important factors into the rating so that those factors are then reflected in the yield spreads. Or the second possible interpretation would be to say that the markets place a lot of emphasis on the credit ratings that are assigned by the credit ratings agencies, so that the markets price the bonds in such a way that the log of the yield spread reflects these average ratings as well as and more importantly than reflecting the macroeconomic variables. So the answer to the question is yes, ratings do add to public information. The final set of regressions that are estimated by these authors tries to determine how the market will react to ratings announcements. So the sample included every announcement of a ratings change that occurred between 1987 and 1994. And it turns out that there were 79 such announcements spread over 18 countries. So for the majority of countries in the sample, there were no ratings changes over that 7-year period. But for a certain subset of countries, there were many, many ratings announcements and therefore a number of different ratings changes over the period. Now there are two separate sets of ratings announcements included in the sample. The first 39 were what we might call actual ratings changes, where the ratings agency, Moody's or Standard & Poor's, said that the creditworthiness of this borrower has changed and therefore we are assigning now a different credit rating to that country. 40 of these, on the other hand, 40 of the 79 announcements that is, were in fact announcements of not actual ratings changes, but of probable ratings changes for the future. So Watch List and Outlook are two lists which Moody's and Standard & Poor's respectively have, where they say that we believe that it's likely that the creditworthiness of this borrower is going to change and therefore that the credit rating assigned will probably change in the future, but in fact that the change hasn't actually occurred yet. So the authors conduct what we might call a kind of event study methodology, where the dependent variable is the change in the yield spread over a 2-day period around the time of the announcement. So from 1 day before the announcement to 1 day after the announcement. And that becomes the dependent variable. If we look at now what are the explanatory variables in this regression model, 4 of them are dummy variables that take the value of 0 or 1. So first of all, for whether the announcement was a positive, i.e. an upgrade, or a negative announcement, i.e. a downgrade. Secondly, a 0-1 dummy variable for whether the announcement was an actual ratings change or whether it was only being placed on the list for a probable upgrade or downgrade in the future. Thirdly, whether the bond is a speculative grade 1, in other words, it's a very risky bond, or whether it's an investment grade bond which is relatively less risky. And finally, the last dummy variable that's used is for whether there has been another ratings announcement over the past 60 days. They also use 2 quantitative variables that are not dummy variables. First of all, the value of the change in the yield spread over the past 60 days, and secondly, the gap between the announcing and the other ratings agency. The argument for using this last variable is that a ratings announcement could have a differential impact depending upon whether the announcement served to increase the difference between the announcing agency and the other one, or if the ratings announcement only served to reduce the gap between the announcing and the other agency, or to bring these two things back into line. If we look at the regression results, there are many, many regressions that the authors estimate in order to try to answer this question, but none of them, unfortunately, turn out to have very good results, and so we'll just look at one set of results here. we only find three variables that are statistically significant in this regression, and these are whether the bond is speculative grade or not, whether there is a ratings gap or not, and whether there were previous ratings announcements over the past 60 days. The adjusted R-squared for this regression is very, very low indeed, suggesting that it's very hard to explain how the market will react to ratings announcements. So if we are now to conclude this paper, the first conclusion we could reach is to say that we found 6 factors that systematically seem to be able to explain sovereign credit ratings. And those factors were incomes, GDP growth, inflation, external debt, and dummy variables for whether a country is developed or not, and whether it has already defaulted on its sovereign debt or not. When we then use those factors combined with some other factors to try to explain the sovereign yield spreads, we find that it is in fact the credit ratings themselves that have more information useful for explaining the yield spreads than all of the macroeconomic variables put together. Finally, it turned out to be very difficult in practice to explain, using systematic factors, which variables influenced how the market will react to ratings announcements. So in other words, we could say that there's lots of kind of idiosyncrasy in the way that markets determine yield spreads in accordance with ratings announcements. In other words, every ratings announcement is different, and we can't find a single set of factors that systematically affect all ratings announcements. Now, if we were to kind of critically analyse the paper and say, on balance, is it a good one or not? I think the answer is probably yes, this is a good paper. It seems to be an important paper that addresses a significant question in finance and something that's of direct practical relevance. But we can criticise the paper in terms of the methodology statistically that they've used. The first thing is that the sample size for the regressions was very small. So there were 49 observations used for the first set of regressions and 35 for the second set of regressions. But there were up to 10 variables, that is 10 parameters to estimate in the regression model. So obviously we don't have many degrees of freedom, and this will influence the reliability or robustness of the results. As we know, many theories in econometrics apply only asymptotically, that is, as the sample size tends to infinity. So we could question whether the results on such a small sample are strictly valid or not. Secondly, usually econometricians would like to view the process of developing a statistical model to be a kind of iterative or dynamic process. That is, usually what we do is start off with a kind of first stage model, and then we'd seek to refine or improve or reformulate or reparameterize that model in order to make it better. But there's no sense that the authors tried to do that in this study. That is, there's no sense that they tried to improve their model by going through a number of steps. Or at least if they did do that, it's certainly not reported in the paper. Thirdly, as we've spoken about already, there isn't really any systematic attempt at diagnostic testing in the paper, and therefore it's quite possible, perhaps even likely, that a number of assumptions which would have been required to ensure that the technique which was used to estimate the parameters was the best one are not supported by the data. And therefore there are a number of problems that we could have that could arise from that, and those problems are ones that we've spoken about before. Finally, we could argue that one problem with the paper is that it doesn't start off with a very solid financial or economic theory. That is, all the authors seem to have is a set of candidate variables that they think might influence credit ratings and yield spreads. They don't really say where those factors come from. They also don't say whether they started off with a kind of wider set of candidate variables which they subsequently reduced when they came to estimate the final model. So if a study is a very good one and a very solid one, it should give information on all of the variables that were initially tried but subsequently moved from the last stage of regression models that are actually reported. And the paper simply doesn't do that. So we don't have any idea of whether the authors tried many, many variables, and then there's the possibility for data mining, or whether these were the only variables that the authors used and these are the ones that ended up appearing in the final model.